Good morning, everybody. Welcome to today's 1 Million by 1 Million Strategy Roundtable for Entrepreneurs. 1M1M, as you know, is the first global virtual accelerator in the world. We run it out of Silicon Valley, but with a global footprint and with a global team. And our mission is to help 1 million entrepreneurs reach $1 million and beyond in annual revenue. In support of that mission, we do these roundtables. And this, can you believe it, is our 299th time that we are getting together in this mode, our free online mentoring sessions. And it's been fascinating. I can just, tell you that it's been absolutely and completely fascinating listening to all of you, sharing these working sessions with you from every corner of the world. And I've learned a lot. We have all collectively learned a lot in the community. And we've had fabulous guests enlightening the path along the way. We have one today as well. I'll introduce her in a moment. A bit of housekeeping. This event is being recorded. You will have the recording available on our blog as well as on our public chat. On our YouTube channel. If you like tweeting the show today, please use hashtag 1M1M. And our Twitter handles are at 1M by 1M and at Stromana. We publish a tremendous amount of high-quality content that's both educational and inspirational. So keep an eye on that content, and you will learn a lot from that material as well. The YouTube channel is 1M1M Roundtables, and that's where you'll find the recording of this session as well as all prior sessions. These are the call-in instructions. We're not ready for call-in yet. I will put these up later on in the program when we are ready for open Q&A, but this is a roundtable. You should absolutely plan on weighing in, asking questions, starting discussions on whatever topic is on your mind. And of course, there's going to be a super important and super interesting topic that we will be discussing today with Heidi Roizen, who's a legend in Silicon Valley. She's one of those very, very few women entrepreneurs who have also been a successful venture capitalist. So Heidi has worn many hats, definitely as an entrepreneur and as a venture capitalist. She has seen the world, the Silicon Valley world, from a very unique perspective, and we are honored to have her as our guest today. Heidi, welcome. It's terrific to have you here.
Thank you. It's an honor to be here and a pleasure to be able to talk with you.
So we have been living in a world of unicorn mania for a little while. And, all of you who are listening to this conversation, if you have been following the material that we have been publishing from 1 Million by 1 Million, we have tried to put some perspective on this issue. There are good sides to the unicorn mania. There are bad sides to the unicorn mania. And a few months ago, Heidi, you did a fabulous piece of journalism highlighting one of those bad sides of the unicorn mania. And I want to start there, and we'll go where we need to go from there. But let's start with one particular piece that you wrote, which I thought was very well analyzed. And the piece was titled, How to Build a Unicorn from Scratch and Walk Away with Nothing. Well, how do you do that?
Well, this is the thing that has, I've been doing this for a long time, and I've seen cycles come and go. And I think there are two things every entrepreneur should be aware of that they really aren't aware of. One is that not everything goes well all the time. If you're an entrepreneur, you absolutely fully believe that everything's going to go great for you, and yet the reality is that is not always, it's almost never the case. The second thing is that our economy moves in cycles, and the macroeconomic conditions will affect your ability to raise money and prosper, again, for almost every company. So if you take those two things in mind, what has happened and what created this sort of unicorn problem, I would say, is that entrepreneurs got very fixated on raising large amounts of money at high valuations because, first of all, money in the war chest seems like a good thing to have, and second of all, being able to talk about your billion-dollar valuation, you know, makes it feel like, oh, I can, you know, I can tell my employees and everybody feels like this is a really solid company and all of that. But there's a falseness under that, because at the end of the day, venture capital is still debt. It is money you have to pay back in pretty much every circumstance, right? It's preferred shares, and preferred shares, in essence, are debt that must be paid back first in any but a terrible outcome, or an IPO where everything goes to common. But we can count the number of IPOs in the last year on not too many toes and fingers, so let's not go that direction. So the reality is the entrepreneurs have made this sort of deal with the devil. I guess I shouldn't say that because that makes it sound like the investors are devils, but the entrepreneur says, I want a really high valuation and I want to raise a bunch of money, because I raise a bunch of money at a high valuation, I don't get diluted. And the investor says, okay, well, but I want some downside protection, because it's hard for me to imagine your company is worth $1 billion today, so I tell you what I'll do. I'm going to put in preferred, liquidation preferences, ratchets, anti-dilution. They put in a bunch of terms that literally I've heard entrepreneurs say, well, there's a bunch of terms on the term sheet, let's not worry about that. And the reality is entrepreneurs need to worry about that, because the terms are more important than the valuation, right? And so let me use an extreme example. Here's a fun example. I went to a party once and I said, I will make anyone a unicorn tonight. I will give anyone a $1 billion valuation. And I had a term sheet and it was printed on my business card. And it said, here are the terms. I'm going to invest $1 in you. I want 100x on my money. And I'll give you a $1 billion valuation, right? So we had a funny joke that night. It's like everyone, I gave about a bunch of dollars with this card, and then everyone could say, I just got funded for a $1 billion valuation, right? But the reality is, well, that's not a very good deal for you. Now, admittedly, it was only $1, but if you have to pay me $100 as return on my money, that's not a very good deal for you. Luckily, it was just $1, so it was kind of fun. But the reality is, again, if you're raising 50, 100, 200 million, and there are ratchets and there are these kind of onerous terms and there are multiples guaranteed and there are all sorts of things on that money, you and your investor are in a very different place, right? And this is, you know, the end of this story, and this is why it's taking me so long to answer the question, is it's actually very complicated, particularly when there are multiple rounds of financing and everybody around the table starts to have different economics, right? You have one person who, if your company sells for $1 billion versus a $500 million versus a $250 million, they're still going to get double their money. And then you have another person who doesn't make a penny until after you sell for $1 billion, for example. Those people are going to have very different economics. And, you know, the one thing entrepreneurs should remember is, unless you are in a highly unusual situation, you sit at the bottom of the stack. You sit below everyone else who has invested money on whatever terms in your company. And so I just think entrepreneurs need to keep that in mind, and I really believe that clean and simple terms at rational valuations are the best healthy hygiene for any normal company that is out there to raise money.
Yeah, and also, you know, so the subtext of all these things that you're saying is that there aren't that many billion-dollar exits.
No,
you know, ultimately, the only valuation that matters is your exit valuation. And if you've got a billion-dollar valuation in a private round, let's say a Series B or a Series C round, you get a billion-dollar valuation, and then you exit for $200 million. What's that?
That's right. I mean, this is the thing that is a little troubling to me, is we have really redefined success currently. Well, now it's coming back. It's rationalizing again.
Yeah.
But believe me, you know, if your goal is, I'm going to sell my company for $1 billion, I'm going to create a $1 billion company, or I'm a worthless human being, you've really set yourself up in a very difficult circumstance. If you just look at the math, right? And if you really want to, and again, this goes back, this actually speaks to the entrepreneur's fundamental motivation. Do you want to change the world with what you're doing, or do you want to ultimately make some money? Most entrepreneurs, I think, will argue, will say, yes, I want to do both. I want to do something meaningful. I want to change the world. But at the end of the day, I'd like to walk away with some wealth creation for myself for having done so. Most companies, again, sell for sub-100 million. Some successful companies sell for sub-300. And even when you get above 300 million, you are talking about a fairly rarefied atmosphere. So I really encourage entrepreneurs every step of the way when you're raising money to run what I call is a waterfall chart. And a waterfall chart is a spreadsheet that shows in various outcomes what do each of the stakeholders make, right? What do I make? What do my employees make? What do my angel investors make? What does this current new money make? And you cannot discern that just looking at a capitalization table because, again, these terms are very complicated. And so I would really encourage every entrepreneur before you take money to say, well, if I take this $10 million of financing or even this $1 million of financing or, as I pointed out, even this dollar of financing, let's run a spreadsheet and say, if my company is worth $5 million, what will I make? If my company is worth $50 million, what will I make? If my company is worth, you know, run your edge cases and understand what you're getting into, because at least then you are knowingly going into that next fundraising, understanding that you've just raised the bar for your exit in terms of the return to yourself and your earliest investors.
Yeah. There are a couple of points that come to my mind as I'm listening to you, is that, you know, we work with these highly sophisticated technology gurus, right? So everybody is a technology guru in some domain or the other, and these supposedly genius people don't understand probability.
No, they don't understand probability. They don't understand simple math. I mean, I joke with, I teach at Stanford, and I teach in the engineering school, and I joke with the engineers because I say, you know, I teach here in the engineering school, and yet I am a creative writing major undergrad, right? I don't have a technical degree. But there are a few things about math I can tell you that I know that it's amazing to me that on engineers, you know, who can do this amazing calculus and everything. You know, I'll say things like, for example, there is only ever 100%. You can't make more of 100%. You can make 100% worth more. But at in every company I know, the cap table adds up to 100%. Therefore, the idea that you're going to pay somebody a percent and you're going to pay someone else a percent, and then every time you raise money, those people need to be made whole back to their percent, that is ultimately impossible math, right? So that's one of those pieces of impossible math. The next thing is this idea that all companies are ultimately valued, and people will argue with me about this. Ultimately, companies are valued at the net present value of their future cash flows, right? That's a fancy business school thing, right? But at the end of the day, a company that never makes money is ultimately not going to be of value. Now, why do people buy companies that don't make money? Because they presume they can bring them into their parent company and ultimately, guess what, make money, either on that technology per se or using that technology to enable other revenue streams. So this is another thing that I sort of, you know, there are some simple things, right? And another simple thing, I think, I see this all the time. I literally will have this genius engineer who will say, well, I have 2 job offers, and one of them is at this company and one of them is at that company, but these guys only offered me 10,000 shares, and these guys offered me 100,000 shares. I'm like, well, that's meaningless. Do you know what the shares are worth? Do you know what the overhang is, i.e. how much debt and venture is sitting on top of the common? Do you know what the terms are about the buyback? You know, again, even as an employee going to an entrepreneurial company, you need to understand, because the face value of these shares is in itself a meaningless piece of data. It's like having an equation that is insolvable because you just don't have sufficient data to actually understand.
And the sad thing is, when you're going for job interviews and negotiating job packages, the companies will not tell you all these details of how much preference there is.
This is fascinating to me. And by the way, I now have to say the disclaimer. I am not currently representing the views of DFJ, the venture capital firm, or my partner. This is just Heidi talking out of line. But my own opinion about this, I just had an argument with somebody yesterday about this. I said, I believe that companies should be transparent about that.
Yes,
I believe
I agree
that
with
actually
that.
when you get hired, someone should sit you down, particularly because your equity package in a startup is a meaningful part of your future plan, right? And I think someone should realistically say to you, this could go to 0. Here's the overhang sitting over you. Here's you know, again, a waterfall chart, not down to the individual person. I don't necessarily believe that everyone should know what pieces everyone else holds, but collectively as a class, I think that anyone coming into a company should actually understand what it takes for their shares to be worth something. And there are certain companies in the Valley for which this is highly transparent. There have been some companies that have said, we're willing to be open about this. And there are other companies that obfuscate this and actually think it's sort of criminal when you disclose this to employees. How dare you tell employees that there's $90 million of preferences ahead of you or something? I just think this is kind of crazy stuff. And you know, I mean, to me, when you're an entrepreneur or an employee and you're going to invest years of your life into something, you should understand what the payout likelihoods are. Now, that said, I think most people grossly overestimate the probability, as you put it, of their payouts, right? And I think this is also a disease here in the Valley. Okay, now I'm on my soapbox. But the other thing is, just because you work for a startup for 4 years doesn't mean you should become a millionaire. I mean, this is, again, the reality of the reality of reality is that outsized rewards for sort of regular work. You could be a really hard worker. You could be doing a great job. But why does that entitle you to be fabulously wealthy from having done so? I still think that there is a huge element of luck and timing to which companies actually succeed. And so the flip side of saying to any employee or entrepreneur, you should understand what your equity package might do. The flip side is to say to them also, you should also realize that that's a little bit like buying a lottery ticket, and you should be at peace with whatever your regular compensation package is. And if you're willing to trade ordinary income for this upside in additional equity, you know, more power to you, but recognize the probabilities, right? Because I think there is a lot of survivor bias in the Valley and a lot of this sense of, you know, I tell my students, well, that's why they publicize the people who win the lottery, because you can identify with that person who wins the lottery, but guess what? You're not going to win the lottery, actually, according to, you know, statistics. So I just think people need to be informed.
So to summarize, what are the top terms that people should be watching for and fully understanding?
Well, the simplest term is preferred, right? And you know, again, it's such beautiful language, right? There are preferred shares and there are common shares, right? Which would you rather be? You know, I'd rather be preferred. Preferred is pretty much the industry standard, right? If I'm going to invest money in your company, my stock is preferred, which means I'm going to get my money out first, right? So that's the first term. Participating is another one, and you know, whether or not that's industry standard, it's just the idea that once I get my money out, is everyone else made kind of more whole first, or now that I get my money out, but I still have all the same rights as everyone else, right? So do I get to participate in the proceeds, or do I have to wait around until everybody's sort of evened up? You know, and again, I'm giving you very vague, these are like first grade interpretation. You should, any entrepreneur who's doing this kind of stuff, if they can, they should get a lawyer who does this. Don't use your Uncle Joe who's a divorce attorney or whatever. There's a very specific language and terms to early stage investing. There's a fabulous book by Brad Feld and Jason Mendelson called Venture Deals. Everyone should read that. If you're going to sell pieces of your company, take 2 days to read a book and understand. This is another pet peeve of mine, is entrepreneurs who absolutely want to control every single thing about their product and their company, but then they don't even know what these terms mean, right? You're going to live and die by these terms, so you better know them. So I think that's a great book. The other big one, and this happens in multiple rounds of financing, but this is, you know, to me, this is a critical thing to understand, is stacked preferences versus pari passu preference. Pari passu meaning everyone the same, right? In a stacked preference, think of it as a wedding cake, although an inverted wedding cake, because usually more money comes in every subsequent round, right? If I'm going to eat that wedding cake, i.e. if we're going to have a liquidity event, I'm going to start eating at the top and move to the bottom. So the people at the top get to eat every piece of that wedding cake before the next layer gets to have a bite, right? As opposed to pari passu means in a liquidity event, we're going to slice that cake like this, and everybody's going to get a piece of that. And again, I'm using a kind of a vague, go do your homework on this. But the point is, when you have stack preferences, and this money usually comes in at different valuations, what you've created is a situation where every person has a very different financial incentive, right? The people at the top are going to make their money no matter what, as long as you sell for a certain amount. The people at the bottom are not going to make anything until you eat that entire cake. Pari passu, when every subsequent round, they may come in paying a different price, right? Their shares may have been more expensive, but ultimately the liquidity is going to flow sort of more equally to everyone, which is a much better construct if you can get it. And again, it's a negotiation. A lot of times you say, well, why doesn't everyone do it this way? Well, I'll tell you why, because if I'm the last money coming in and you kind of have not necessarily made a lot of progress, you raised, I say to some people, I say, you know what, the good news is you've built a nice little $10 million company. The bad news is you burned through $50 million to do it, right? If that's you and I'm the next money in that's going to help you get to profitability, I don't want pari passu, right? I'm going to say, well, what the hell, those other people, you kind of wasted their money. I don't care if they get their money back or not. I'm going to give you more money, but it sits on top of everything else. So again, these terms were all invented, generally speaking, for reasons of downside protection for the investors, right? And that is the reality, right? It's a negotiation. It's downside protection for the investors versus it's as entrepreneurially friendly as it can be for the entrepreneur who's negotiating the other side. So the point being, just understand these terms and understand how they impact not only what your return is, but the motivations of everyone else around the table, right? Because when you set up a situation where someone's sitting there and they're going to make 3 times their money no matter what, and they're going to be the first money out, and then another person is sitting at the table and they're only going to make money if you sell this company for $200 million, you are talking about 2 people who are going to dramatically have dramatically different ideas about strategically what you should do in your company. And that, to me, is a very divisive thing. That's what I, as an entrepreneur, and again, remember, I've been a VC now for, I don't even want to think about it, 16 years. But I was an entrepreneur for 14 years before that, and I raised 2 rounds of venture. And so I've lived this as an entrepreneur, and I've lived this as a venture capitalist. And I would tell you that even though I understand why VCs negotiate for these terms, and I myself at DFJ have negotiated for these terms, right? Participating preferred, stack preferences, multiples on exit. Trust me, I'm quite happy to do that because that's the business we're in, is to try to return money to our limited partners. But at the end of the day, when you do these things and when you trade a high valuation for this other stuff, you're going to create a divisive underlying shareholder base, and that is going to come around usually to hurt you unless everything goes super well. And pretty much in my history, I think I've been on about 40 boards in my life so far. Very rarely does everything go perfectly, right? I mean, it's just very rarely does it ever go perfectly.
And I think that's kind of the problem with this unicorn thing of raising too much money, is that one, you're working a very, very low, you're betting on a very low probability scenario for success. Right. And 2, you're introducing levels of complication that you yourself have a hard time understanding, let alone other people understanding.
Right. Absolutely.
So complexity, actually, I think successful entrepreneurship or successful anything actually is not taking uncalculated risks. Calculated risks are good, and actually success comes from mitigating risks that you don't have a lot of control over. So the truth is, you're working in the probability scenario that you're working with is the higher number of success, the higher probability of success is in the $100 million exit scenario, which means that you have to do a company without burning more than $20 million, $25 million to be able to make any money at all.
And
any reasonable amount of money.
Even $100 million success
is a low probability
really
scenario.
Unlikely. I mean, this is another thing I've explained again to entrepreneurs. I say even at the small ranges, if you raise $2, $3, $4 million, right, and you have simple terms and it's a reasonable valuation, whatever. Even if you sell your company for $20, $25 million, that is a life-changing experience usually for the couple entrepreneurs at the founding level. For most people, if you walk away with $5 million, $5 million is a lot of money. You know, even in Silicon Valley, you can, you know, buy a condo for $5 million. No, I'm joking. But, I mean, $5 million, again, most people don't, you know, just process that for a minute. $5 million is a life-changing amount of money for most people. If you have raised $15 or $20 million and you sell your company for $25 million, you don't make anything, right? And so, and again, so when people do this where they raise a bunch of money and they say, well, it's my safety net to make mistakes, but then they create this sort of, you know, this debt that needs to be repaid, they also create a barrier to new people putting money in because they look and they say, well, those guys expect to get their money back, and I worry more about the people at the bottom of the stack because those are the employees. You know, you just create these structures that don't work, and I'd argue, why do that? And I understand because entrepreneurs will say, well, I need the money, and I also will put a disclaimer in here. There are certain types of companies, and by the way, I say this in part because DFJ has a history of investing in some of these companies that are disruptive. They're capital intensive. Some of them take hundreds of millions of dollars of investment before you get to the first customer, right? I mean, SpaceX. Like, you can imagine if in the downturn you don't sit around at SpaceX and go, well, let's cut to profitability. You know, instead of building rockets that are going to, you know, go into the space orbit, why don't we just try to get to, you know, Lodi with something? You know, that doesn't work, right? There are just certain types of capital-intensive businesses. Tesla, another one, right? You're not going to build those. Sometimes you have to take a leap of faith and raise lots of money on a big-ass thing. But for most companies, right, most of the companies I see that are trying to, you know, kind of bring an evolution of something to a service business or whatever, actually you could, you know, and I'll say this, is even as a venture capitalist, my favorite form of financing is customers buying your product, right? Because it's validating, it's non-dilutive, and so if you, as an early stage startup, can figure out how to get somebody to pay you for what you're doing, that is golden. That is the best, absolutely the best money that you can use to build your business. And I just would encourage entrepreneurs to really think about that, as opposed to going and raising funding, to really think about, can you get your business started by someone who's going to value what you do and is going to pay you for doing it without taking that equity dilution.
This is the mantra in 1 million by 1 million. You know, our definition of entrepreneurship equals customers, revenues, and profits. Financing and exit are optional.
That's
so
right.
You just underscored exactly that. Heidi, one point you made, which I think is an excellent point and is a perfect kind of summary of what you discussed today. Investors are portfolio managers. You are not.
Yeah.
Could you elaborate?
Sure. You know, I think this is the thing is, you know, like currently at DFJ, I'm responsible for 8 companies, right? So there's 8 companies that I am a board director and a board observer. And believe me, I try as hard as I can for those companies. I show up, I'm responsive, but I have 8, right? And I'm making decisions even among those 8, and again, in the broader DFJ portfolio of 100, if we subsequently, you know, especially in a fund that's closed, right, a fund that is no longer making new investments, no longer having new capital come in, $1 million into one company is $1 million that's not going into another company, right? And so we're portfolio managers. We're looking across the field and we're saying, who's got the best chance of returning this money, who might need a bit of a save, who do we just feel isn't going to make the cut? And yet you as the entrepreneur, 100% of your eggs are in that one basket. And so I just think it's important to remember that your outcome matters to you more than your outcome matters to your investor usually, who has multiple bets, right, and who is going to be judged by their performance across the whole portfolio, not just across your deal. So again, I like to believe that, you know, emotionally, spiritually, whatever, as the friend of the entrepreneur, I show up and I work as hard as I can. But then in the background, I also have, I and my partners have 100 companies, each of whom sit in a fund, each of which has limited funding, and we have to make decisions between who gets the limited remaining resources. And, you know, we're portfolio managers at the end of the day.
Heidi, this has been fantastic. You have given a lot of pointers, and like you said, folks, do your homework. She's given you pointers. She's given you the framework of what to study. But you got to study, and this is what we do here is that we give people frameworks and structures and philosophies and you know, ideas but they need to study. I'm looking for rigor, guys. You know, this is technology business. You guys are supposed to be geniuses. Work hard, do the homework, and then make decisions. Don't make these off-the-cuff, stupid decisions driven by media hype. It's stupid, and don't be stupid. That's the end of the story, right?
Don't be stupid. Is that the new mantra? Don't be stupid? Well, you know, I love what you're doing, and I'm a huge fan. So this has been great.
We'll talk soon.
All righty.
We'll talk again soon. Thank you. Bye. Thanks for coming. Folks, we're going to switch to the entrepreneur pitch session. I hope you enjoyed the first part of the show. You know, you really have to pay attention to everything we discussed in the first 30 minutes of this session. I can't underscore how important this is. So, as we're starting the pitches, I want to set some expectations for our presenters today. Maureen, could you freeze the video, please? This is a working session. We are here to make you successful. And we are completely on your side. There is absolutely no other agenda here other than us supporting your work as an entrepreneur and becoming successful in your entrepreneurial journey at whatever scale you do this at, with whatever is the right strategy that you need to follow. We're going to try to help you make those decisions. We're trying to accelerate your learning curve. It is a very steep learning curve. I mean, I'm sure, like all the things that you heard today, a lot of it is new material, but you know, this is the game we're playing, and you're going to need to study, and you're going to need to learn, and we're going to help you through that process of learning. We're going to shepherd you through that process of learning, and that's why we're here. Now, you're going to get feedback here today. You may disagree with that feedback. That's okay. It's your company. At the end of the day, it's your company. You make whatever decisions you want to make. Take into account, take into consideration the feedback you're getting, because you're getting this feedback from people who have experience. The other thing that I want you to remember as you go through this with us is that don't be obsessed with financing, and most certainly don't be obsessed with unicorns and unicorn valuations and all this mumbo-jumbo, because not all businesses can raise money, not all businesses should raise money, and raising money does not guarantee success. You just heard a huge 30-minute discussion on how many ways you can fail after raising huge amounts of financing. So, let's get going. If you're not pitching, please do participate in the public chat, and also I'll open up the line for Q&A participation later on in the program. So it is a roundtable. I want you to participate. We want you to discuss issues, bring up issues, and so on and so forth. So let's see what we are looking at here. Raviteja, you're first.
Yes. Hi, Samana. How are you?
I'm all right. And you?
I'm fine. Actually, can I start?
Yes, please start.
Yeah, thank you. Actually, we are from India. So we started our journey in 2015, January. So next slide, please.
And the name of your company is Free?
Yeah, FreeYou. It's FreeYou.
FreeYou. Okay.
So we are running with a team of my senior colleague, technical head, Prashant Babu, and me, myself, Ravi. So we can go to freeyou.in, which is our website. So here what we offer is, it's simply in a single line, sponsors or investors on demand through mobile platform. So this is what we offer to our customers. So here the sponsor or investor can be an individual or an organization, to whom we mainly concentrating, especially will be of aesthetics or any student or working professional or whoever person trying to get emergency alternative investment to keep his journey moving on. So next slide, please. Yeah, and here we make money through transaction fee of the user which has been joined in our platform. We will be making transaction fee for every transaction through our platform and through advertisements. Especially let's say a startup trying to reach out to more people, so they come up with free deals, right? So they will be placing their free deals in our website, which we'll be getting through that thing. And next slide, please. And why? Because we had faced this problem when we started early. Why? Because we hadn't any credit score and no experience in regarding to the private investment sector. So we just thought of okay, why can't we move on to the VCs and angel investments? And we got literally rejected in every proposal and everything. Why? Because we haven't got the product even matured enough, so why are you even trying for the investment? So we need to get going, and we need a platform where our talent has to be showcased, and it has to be recognized by someone who can trust us to make our journey move on. So we just came up with this platform where we are trying to reach out to the sponsors or investors who they think that okay, you have come up to this point, and we will be helping out. We will be helping out from especially what our requirement will be of small in case of get to the other traction. Let's say if I am a self-employed driver, so I can I need a cab in order to reach out to the person. So we'll be reaching out to those organizations or individual sponsors who are willing to provide his cab under a guidance system, supervision. They will be guiding every transaction through them. Yeah.
Do you have anything else to present? Because I have a ton of feedback for you already. Do you have more slides?
No. You continue, ma'am.
So, this presentation, what I see here, nobody will finance this because it's missing all the pieces that an investor needs to consider an investment. It doesn't have anything. It's just a bunch of concepts, and it doesn't have anything underneath that, and even the concepts are not fully fleshed out. So if you, first and foremost, if you go to, by the way, the terminology you're using is not even quite correct. This is value proposition, yes. What you have here is not value proposition, it's business model. What you're trying to do here is provide some sort of a marketplace for investments. But you don't really understand investments. What I see here and what I heard you present, my sense is that you don't really understand investment or how investment happens. So if you kind of take each of these different customer segments that you've outlined here, athletes, education, skill development, small, medium enterprise, startups, alternative investments, each of these, these students, working professionals, self-employed employees, whatever you're talking about, you need to understand how does financing work in each of these scenarios. So if you take athletes, for instance, and if you're trying to create a marketplace where athletes can get sponsors, that has its own dynamics, and that is a business in itself. And I have no reason to believe that you understand that domain, at least just, the cursory way in which this has been presented. I have no reason to believe that you understand that process. And I am absolutely 100% certain that you don't understand startup financing at all. because you are going out to raise financing with this as your collateral, and you're getting rejected left, right, and center, and that tells me that you have absolutely no understanding at all of startup financing. And that's scary because you're trying to build a business to facilitate something that you don't understand. And that's basically a recipe for failure. So how do you mitigate that situation? I actually believe you can learn everything. Everything that you want to learn, everything that you need to learn can be learned. You're just going to have to work hard, you're going to have to investigate, you're going to have to study, and you're going to have to bring the knowledge base together with which you can build your business. So first and foremost, for your purpose, as well as the purpose of understanding what business you're trying to do, you need to understand startup financing.
Okay.
And if you want a direct pointer to where you can learn that, you can go to the 1M1M basic program. There's a 1M1M curriculum that we have just very recently this year started making available as a monthly subscription, and you can go study the startup financing module there and understand what gets financed, how it gets financed, what are the requirements, et cetera, et cetera. So that's one way you can mitigate the gap in your understanding of how investors work in the startup financing mode. Now, if you want to understand athletes, then you need to go find people who sponsor athletes as well as athletes who are being sponsored and the officials in the sports industry who can help you learn how the whole athlete financing, business works. And likewise, every single thing that you're trying to do here, you will need to understand, and then maybe you will come to the conclusion that, oh, it's not possible to do all these different things. I want to do one thing. Maybe your conclusion after doing the due diligence will be that you're going to position this business to just address the athlete financing challenge. So this is going to be a marketplace for athletes looking for corporate sponsors. That is potentially a positioning. Now, what that means that you're going to need to understand the domain and the discipline and the methodology of positioning, which also you don't understand. So you have a bunch of knowledge gaps which need to be filled before you will be able to move forward and convince other people to do the kinds of things that you want them to do, like invest in you, like, getting to the next level. So at this point, Ravi, my guidance to you is you have a lot of knowledge gap plugging to do. So if you hang around, I'm going to talk more about the resources for plugging those knowledge gaps later on in the program, and you can decide which of those mechanisms you're going to use and how you're going to plug this knowledge gap. But right now, I see gaping knowledge gaps that have to be plugged for you to be able to be successful.
Sure.
Okay? So hold on for a bit. Let me talk to Mayank, and then I will explain to you what to use, and then we'll do more open Q&A, and I'll answer more of your questions after you've listened to that piece. Okay?
Thanks. No problem. Bye.
All right. Mayank, you're up next.
Yes, Samana, thank you. So shall I start?
Go ahead. Yes, please.
Yes, okay. Good morning once again, and thanks to all of you and to Samana particularly, who's given me this platform to be able to present to you today. Next slide, please. So I started this firm, Moon Technovision, which has brought this app, mobile app, Let's Go Social, to life. Let's Go Social is the mobile app that integrates all the social networking sites that one is active on. So one is like, for example, if you're active on Facebook, Twitter, LinkedIn, Google+, Instagram, all these mobile social networking sites, that is, they can come to you on one platform in one screen on your mobile handsets. So it integrates all these social networks, so you do not have to surf through each one of them individually, and you get the news feed from all of these in one screen. And another benefit is that you can update your status on all these social networks in one go. So you do not have to retype, copy, paste your status on all these networks individually and one by one. You do it in one go. Next slide, please. Just introducing the team, myself, I have 16 years of work experience in textiles. I'm not a technology guy at all. Let's Go Social was my idea, and I just shared it with my friend who's Ajay, and who is the technical brain behind this. He's the one who developed the app for me, and now we are together. Next slide, please. The pains that Let's Go Social as an app aims to solve is that how to save time and still be active on social media, because if you want to stay active on various social networks, it is a time-consuming activity, and many people stay averse, from being active on various social media because it consumes a lot of your time. And this is also actually hampering a lot of the social networks and increasing their traffic. For example, Facebook is the biggest. It is almost 1.55 billion users now it has. But the other social networks, because Facebook has become so big and everybody, all your friends are already on Facebook, it is hampering the growth of Google+, it is hampering the growth of many other social networks, because you're already getting everything on Facebook. So but there are positives, there are benefits of other social networks as well, but you don't explore because you feel you're lethargic, you feel networking lethargy, that being active on various social networks and then maintaining all of those networks would be difficult. So this is one of the biggest pains today, which Let's Go Social aims to solve. And then it also enhances your privacy, because we all come across this particular problem when a junior in your office asks you that I've sent you a friend request on Facebook. Now you have all your personal contacts on Facebook, and now you do not want your official contacts to mix up with your personal contact. So and you're not active on other social networks. So what do you do? And it is an awkward situation to say no or keep the friend request ignored, because your junior will feel bad about it, and you want to keep the official, the harmony in office also intact. So now, because with Let's Go Social, you are active on LinkedIn, also you're active on Twitter, you're active on GoSociall, on Google+ as well. So you might tell your junior that, okay, on Facebook you have your personal contacts, so you can always be connected with me on LinkedIn. So you're keeping the harmony at the office also, and you're keeping your private contacts and personal contacts, friends away from your professional links. So next slide, these are the pains that Let's Go Social aims to solve. Yeah, the tech concept, we just wanted to, I'm not a tech guy, and unfortunately Ajay is not with me here today. It's a social hybrid app built on PhoneGap platform, and it captures the APIs of various social networks. That's how it brings all the social networks on one screen. Next slide, please. Okay, most of the solutions that I've already, the advantages that I've already spoken, the pains that get solved. So, and one more thing, that this app comes to everybody, to the mass users, at free of cost. These are some of the screenshots of how the app looks. It's already live. It's available on iTunes.
I don't understand how this works. So far, based on what you said, I don't understand how it works. So walk me through what is happening.
Okay.
Walk me through, if I'm using your product, what is it helping me do?
It is helping you to get your news feed on all the social networks, from Facebook, from Twitter, from Google+, from LinkedIn, coming to you on one screen of your handset. So you do not have to,
But I don't want that.
access
I don't think I want that at all.
No, there are people, see, but if you're not active on various networks, this app is not useful for you. But if you're active on various networks, I am active
on various networks, but I don't want those networks to mix.
Yes, that's your personal choice. And yes, the newsfeed that comes to you on this, you can filter it as well. You can keep it segregated as well, and you can get that all mixed up. See, now for example, if you have to wish your audiences on Christmas, on New Year's, you do not have to type your status again and again on LinkedIn separately, on Facebook separately, on tweet it separately. You do it all in one go. Saves a lot of your time. That's the biggest USP.
Okay, so Mayank, the question that I would like you to investigate honestly, and you have to really have complete openness and intellectual honesty about it, is what are the use cases? What are the real use cases that may be drivers for people wanting to have the ability to post to all the social networks at once? Is having all these news feeds coming into one screen, is that even necessary? Is that something that I would want? Because today, you know, the use case that you started with is that, you know, you're maintaining your personal network on Facebook, and somebody from the office wants you to become friends with him on Facebook, and you don't want to do that because your Facebook network usage model is personal, which, by the way, is not always the case. People mix all the time. But the answer to that could be, you know, my professional network is on LinkedIn. Please join me on LinkedIn. And you just answer that, and that's how you deal with your professional people. If your usage model is that Facebook is personal, LinkedIn is professional, that is not my usage model. For me, actually, LinkedIn is definitely professional. Facebook is both professional and personal, and I don't put anything that is particularly personal on any of them. For that, to the extent that I use for personal stuff, I use instant messenger, or, you know, Facebook Messenger, WhatsApp, or small Facebook groups that are, you know, groups with family members. All those are, you know, non-public modes of usage. So I think what I'm missing here is a compelling reason, is a compelling set of use cases that warrants what you're trying to do and will drive adoption for your product.
Yes.
And you can't go to market without that sorted out.
Yes, that's right. I mean, yes, it is a very valid point that why people would really want to mix up, and would they really need to, you know, would they really want to update their status in one go? That's really valid question. Now, the next slide, which you have already put up here, is showing. You see, now the number of people who are growing on multiple social networking sites is increasing. From the last year from 2013 to 2014, this is the Pew Research. The people who are active in multiple social networking sites is what this graphic shows, and which is the case study, which is the market for our product. Next slide, please. The competition. Already there are sites available who are doing this. This is not exactly a unique idea. Hootsuite is already there. Sprout Social is there. eClincher is there. All these sites are paid sites, and they're not targeted towards individual users. These are more towards corporate users who want to manage their social media. All these products are targeted towards those, and they are paid services. Next slide.
So we are heavy-duty users of Hootsuite.
Sorry, again?
We are heavy-duty users of Hootsuite. And there is a very clearly understood case for what is the benefit, what is the value of Hootsuite, what is the use case of Hootsuite, and so forth. It's mainly marketing, social media marketing management platform.
Yes, that's right. Absolutely right. So exactly, they're not towards the individual users. They're not targeted towards those. Now, the business model, actually, frankly, Sramana, here is what today's pitch, what I wanted to actually learn from you. I wanted to keep this absolutely free and absolutely ad-free as well. Okay, we all know that WhatsApp was free to use in India. It has more than 1 billion users in India. It was always free to use. Okay. However, only recently I came to know that it was not free to use. It was a paid service in the Americas. Okay. I do not know how for 5 years the 50 member staff that WhatsApp had survived. Like, was it that the owner or the promoter continued to pump in money in the business, or was there any revenue model? I do not have any insight into WhatsApp, how WhatsApp did what it did, and how did they survive for 5 years before they took over. So I wanted to keep my service also absolutely free. However, the few people that I came in touch with, they said that you have to have some revenue model, and only then the investors will start to look at it. Of course, because the way I'm passionate about my idea, I've not been able to find someone who gets as passionate about it. For example, you've also raised a question about which is a very valid question. But I do have, the gut feeling is something else, but you have to have hitting the reality on the ground and have your facts cleared, whether there would be a market, whether there would be people who would be needing this service. So which is a very valid question, and I'm working on it, finding data on the internet with my limited means, whichever way I can. So my main reason to be a part of today's program, your program, was to understand this question. Is really a revenue model so important? Let me
answer your question. First and foremost, WhatsApp was initially brought to market bootstrapped, and it started catching like fire. It was a very valuable, very useful service that people used to communicate, and there was a gap in the market for free SMS, basically free chat kind of functionality, including group chats and everything, and it caught on really fast. It was growing really fast in terms of adoption, and as a result, they were able to attract huge amounts of venture capital. So the answer to your question, how did WhatsApp survive for so many years, 50 people team, without any revenue model, is that because they were growing fast, they were able to get venture capital. Now, we're not talking 5,000 users. We're talking hundreds of millions of users. WhatsApp today has 1 billion users.
Yes, absolutely.
And when Facebook acquired the company, I think it had already had 800 million users. So, and when they started raising financing, they already had millions of users. So this is a company, this is a service that caught on like wildfire, absolutely. So this, idea that 5,000 users, and by the way, ad revenues are minuscule. Okay, ad revenues, mobile ad revenues, the rates are terrible. So for you to make any reasonable amount of money, you're going to need millions of users before there is any reasonable revenue coming in. So for a business to be sustainable on mobile revenue as their primary business model, 5,000 users is not going to cut it. You're going to need 5 million users, and it's very difficult to get to 5 million users with anything, with any app. So the question is, how are you going to build something that catches on to millions of users? Because there's a big chicken and egg problem here, which is investors are not going to invest unless you show that level of traction. And how are you going to get to that level of traction? How are you going to finance that period? In the case of WhatsApp, it happened very quickly, and they self-financed the early part of that catching on thing. So the point, the summary, the net out of all this is that valuation without revenue businesses, or businesses that want to get to millions of users and then raise financing and look for an exit essentially without a business model, is a very slippery slope. You just listen to the conversation with Heidi, right? We were talking about probability. The probability of success of startups in general is very low. The probability of success of WhatsApp kind of businesses is 1 in 10 million.
Right.
So from your point of view, you have a gigantic question mark looming above you. Is this kind of a probability game worth years of your life? And that's the question I need you to answer.
That's right. You're absolutely right. I mean, I am trying to find an answer to that because I feel passionate about it. However, I need to have funds to reach the product out to the market. I am trying to have as many social media channels, use as many social media channels which are freely available, which are not very expensive. However, I mean that is not going to serve my purpose, I'm sure. But whatever limited way I can start promoting the product on my own is what I'm doing right now.
Yeah. So I would say that there is a question mark in my mind. There's a question mark against should you be doing this business at all? And you have not answered that question for me. And I would like you to really ask yourself this question as intensely and as rigorously as possible, because the business you're going into has such a high probability of failing. It may just end up wasting so many years of your life and draining so much of your resources, it may not be worthwhile.
Okay, I get your point.
Okay.
Thank you.
So as I said, this is all probability mitigation, risk mitigation, probability management. If you want to be successful, you have to have a path to success that has, somewhat higher probability. So.
Okay.
So I'll talk more about resources in a moment. So just give me a few moments, and we'll come back to Q&A. We can continue discussions as you're absorbing what I'm telling you. And both you and Ravi, I just gave you, serious feedback that you're going to need to observe. I will have more time to answer more of your questions. And Ravi, there are some areas I just flipped through your slides. I didn't realize you had more slides since you asked me to stop there. You seem to have started receiving traction in some segments. So that will give us cues into where you may have understanding and where you may have achieved some product market fit. And then we need to steer you towards that positioning potentially as your, go forward path. So I'd like to, talk to you more about that in a moment. So quickly, here's how to use the 1M1M resources. And by the way, if you like what we are doing in 1M1M, please bring serious entrepreneurs into the program. And by serious entrepreneurs, I mean people who have the rigor, who are willing to study, who are willing to learn. And this is a complex game, okay? So if you want to play this game well, you're going to have to learn a lot of things. And it's a very, very steep learning curve, but this is the way to succeed, is by learning the nuances and the complexities of this business. And we are really trying to give you a platform where that learning is accelerated at a fantastic pace. And we are successfully doing that with huge numbers of entrepreneurs. So if you do have someone in your life who is trying to be a successful entrepreneur, feel free to bring them into this program next time, and let's give them the platform to succeed. Now, everything in terms of resources is at 1mby1m.com, and you will find a blog that is free. There's a ton of content that is free. A lot of these YouTube channel content is free, so there's a huge amount of free content that you can access through our platform, which will help you move along and make a lot of progress in your journey. The Entrepreneur Journeys book series is another body of resources that you can learn from. These are 12 volumes of books that are case study based, and they double click down on a specific topic. So if you're building an e-commerce business, the book in that series to read is From E-commerce to Web 3.0, how the web is evolving and what's succeeding, what entrepreneurs are succeeding, how they're succeeding, why they're succeeding. So if that's your domain, that would be one to double click down into. On the other hand, if you are trying to learn different mechanics of bootstrapping, we have 3 books. Bootstrapping, Weapon of Mastery Construction, which is EJ2, Entrepreneur Journeys Volume 2, Bootstrapping Using Services, and Bootstrapping with a Paycheck. These are specific books that deal with those topics. And this $1 Billion Unicorns actually deals with the topic that we just discussed of WhatsApp and what happened at WhatsApp, what happens to these valuation without revenue businesses, how they get built, and what is what is your probability of success if you go down that path kind of discussion, and purpose is very much, it was top of mind when I was writing that book, and it is something that I've dealt with in billion-dollar unicorns. And in fact, billion-dollar unicorns is a very good methodology discussion on how you can actually get some control over this low probability journey of building a real successful unicorn company. And there are a bunch of case studies in there that have that dynamic. So go to the website, you will find lots of videos, lots of material. We are approaching our 300th roundtable next time. You know, thousands, tens of thousands of people have come to these sessions and have been using them to learn from. You need to go to the free public roundtable page and register to pitch or to attend if you want to do so. And then we have a premium program where we give you extensive methodology guidance. We have a curriculum that is taught in video lectures and case studies. Over 700 successful entrepreneurs and tons of investors have helped us build this curriculum through their perspectives, their journeys, etc. We help you with business development, we help you with extensive strategy consulting, and we help you with financing and media relations. That's all part of the premium program. The $1 Million Club on the website gives you pointers to success stories in 1M1M, and the 1M1M value creation our ROI analysis, which is $375,000 plus 5 to 10% equity worth of value for just $1,000 annual membership fee. The 1M1M self-assessment is something that I want all of you to go through. And Ravi, Mayank, please make a note of the 1M1M self-assessment. Maureen, if you could put the link on the public chat. You need to really ask yourself these questions and see what you can answer, where you're getting stuck, and where you're getting stuck, plug the knowledge gap. If you decide that you need to access the 1M1M curriculum to plug those knowledge gaps, there is the 1M1M basic program, which is a monthly subscription, and you can subscribe to that and rapidly plug those knowledge gaps. Maureen will give you all these links in public chat. And then, you know, just kind of follow along the methodology. You know, you really have to extract the nuggets out of your idea and test them against reality. You are passionate about something. You have to be passionate, otherwise you wouldn't even start a company. You know, without passion, there's no point starting a company. So I respect your passion. Your passion is necessary for success. But passion decoupled from reality, passion decoupled from methodology is not going to help you succeed. You're going to have to bring all those elements of success together and be able to execute. Right, so that's why I'm pointing you to these resources. On the website, you can just look around. There's a ton of material to understand, you know, both understand methodology, learn from the blog and the resources that we provide for free, as well as material about how to use the 1M1M program, what pieces are available, and so forth. So the website is very rich. Spend time on it, and you will get, you know, a lot of insights. The reason we use case studies, by the way, as our primary way to impart the knowledge is because many years ago, 10 years ago, I felt that in Silicon Valley we have accumulated a huge amount of knowledge, but that knowledge is sitting in the heads of a small group of people, and if you have access to that inside network of Silicon Valley, you will be able to access that knowledge. But for the greater majority of entrepreneurs, and entrepreneurship has spread tremendously in the last decade all over the world, that knowledge is not accessible. And I thought that if we could bring all these people and their successes and their knowledge base and their, you know, tribal knowledge, so to speak, and institutionalize it, then entrepreneurs from all over the world can access, and all over the world entrepreneurs can learn from these people who have been successful. So this is the philosophy that's at the heart of the 1 Million by 1 Million curriculum, and we indeed have had over 700 successful entrepreneurs and numerous investors participate in building this curriculum. Our methodology is lean, capital efficient, bootstrap startups. Remember all this probability discussion we had earlier, and I said, you know, if you want to hit one of those $100 million exit points, even forget billion, even this $100 million exit is a low probability game, but if you want to hit that, you have to build a company for under $25 million. And, you know, and Heidi said, reinforced that point by saying, actually, the better strategy is to aim for a $20 million exit and really keep things tight, so that as you build and as you gain success, maybe there will be additional opportunities opening up, and you can, you know, you can make conscious decisions of, okay, now I'm playing not for a $20 million exit, but for a $100 million exit, but you're doing it in a very systematic, very capital efficient manner so that you hold on to equity, you don't get washed out by these liquidation preferences and so on and so forth. So our methodology is lean, capital efficient, bootstrap startups. Even if you're working with investor money, work with small amounts of investors' money and bootstrap even with that. So you don't want to get into this very heavy capital investment game unless you are certain that you can actually succeed in that game. And our philosophy there is bootstrap first, raise money later, and definitely delay raising huge amounts of money. Do not start by raising huge amounts of money. And in any case, you will not succeed because these days investors just don't put in huge amounts of money in unproven concepts. Okay, so you know, we have a huge footprint in media and social media. So the last point that I want to make is that we are happy to help you get the word out about your business, your product, your value proposition through that channel as well. That's also part of the 1M1M program. So that's pretty much what I want to share with you in terms of how to use 1 million by 1 million. A few other pointers. We do have a partnership program, and if you're building a community of entrepreneurs anywhere in the world, please feel free to use the 1M1M program as an affiliate partner or some other kind of partnership. We partner very well. We have a lot of partners that we work intensely with. Now, every week still, until the end of April, we have these free roundtables. So sign up. There is a milestone event, which is next week's 300th roundtable, and we look forward to seeing you there. If you're in the ideation phase and if you're working in an emerging market, I recommend looking at Vision India 2020, which is an ideation book. You will find a lot of ideas there that will probably trigger ideas for you, and you can also borrow, you know, steal, morph, mash up ideas from there. The Incubator in a Box is our partnership platform to work with corporations and governments and so forth, and we have a bunch of partners in that mode for whom we run incubation programs on their behalf. So that's pretty much it in terms of what I have to share with you. We are ready for open Q&A, and we have quite a bit of time. So if you want to start asking questions either by phone or by public chat, please do so. And I have a question for you, Ravi. What we didn't get to, I saw that you are actually able to get traction somewhere. Can you elaborate where you're getting traction? So I can give you a few more pointers on which direction to investigate in more detail. Is it athlete sponsorship where you're getting traction? Is it student sponsorship where you're getting traction? Folks, feel free to use the public chat to ask questions. Just make sure you send the public chat to send to all participants so that everybody can see your questions. Don't send private chats to me or Maureen, then people won't be able to see your questions.
Hello.
Yep, Ravi, is that you?
Yeah. Actually, the question point is regarding to the self-employed. Let's say our neighbors who are available with us. Let's say, I had deal with my friend's mother who is keenly interested in the sari selling, in which most point like let's say the customers, the friends usually used to ask her, your selection is good. How come? Where can we find the similar material wise? So I just helped her out with the sponsors. Investors to reach her.
I don't understand, Ravi. You're not explaining this well. Who is paying for your service right now? Where are you generating whatever revenue you're generating? Where are you generating that revenue from?
With self-employed, yeah.
With self-employed.
I just need regarding to the working professionals wise who are trying to come out as employees to the employer, who just wanted to start their business with the skill whatever they.
And what? So give me an example of a matchmaking that you've done in the scenario of a self-employed person raising money through your network.
Yeah, actually, my media professional guy who is professional in media with an experience of 25 years, but he had no knowledge of how to reach to the investors. He don't know the way to reach out the guys. So I just gave him those points, let's say Android development aspect and different video productions wise, commercials wise, advertisements wise. I just used to go for client wise. So I just integrated investors point to the film. So we just
I don't understand, Ravi, do you really need to refine what you're doing? It's very difficult to understand what you're doing and why you're doing what you're doing. So there is a, really clear gap in your clarity in your own mind about what is this business, and B, how you communicate what you're doing to people who would want to work with you in whatever capacity.
Sure.
So I think I kind of maintain my advice to you that you need to do some studying and learning and really refining how to go about building this business.
Sure. Thank you, Shamana. I will try my level best. Yeah.
Okay. And by the way, it's perfectly doable. I also do believe that you can learn, and all of you can learn. And learning is the easiest thing to do. If you follow a rigorous process, if you put in the time and the energy and the focus, learning is the easiest thing to do. But you do have to focus on, put learning front and center in your life so that you can then do what you learn, you can execute on what you learn in your project.
Sure, Shamana. Thank you. I will do.
You're welcome. Who else? Anybody else? Questions, comments, issues that you want to discuss? Please use the public chat or call in, whichever way you want to engage is fine. Folks, those of you who are interested in asking questions about the 1M1M program, please feel free to contact Irina Patterson, irina@1mby1m.com, and she'll be happy to answer your questions. Anybody else? Questions, comments, issues? Yes, no? All right, well, if nobody has any questions, then we're going to adjourn the session, and hopefully you'll come back next time for our 300th roundtable, and I look forward to working with some of you there. And keep going, keep studying, keep learning, keep executing. Good luck with all your projects. Thank you very much. Bye-bye.